We were at the game on Friday night, Gabe and I, but also with our pal Dave Skirman from First Ontario for a little get-together with the Morning Live crew and Dave, and it was good to see you in person, Dave. Give you a big hug because we've been doing this virtually for too long. So thanks for having us on Friday. Is it true? Is this the penultimate episode of this season? So you got one more left before you're off for the summer?
One more left. And in fact, I'm going to be in the studio next time in 2 weeks' time for the first time since the pandemic. I'm really looking forward to that, Tim.
Well, it's going to be great you beat me to work. You're here at like 5 a.m. eating the donuts and stuff. So I can look forward to seeing you in a couple of weeks. Okay. We're discussing a hot topic everyone's talking about, rising interest rates and the volatility in the stock market. So let's start with interest rates. Listen, Dave, how much higher can they go? And I don't know, can we cope with them going up?
Well, it is timely because Morning Live is reporting this morning on the Bank of Canada's comments yesterday. Mr. Macklem, the governor of the Bank of Canada, spoke yesterday to the media, and he said interest rates could be double before they stop. And that, of course, he's referring to the benchmark rate that the Bank of Canada sets. That's the rate that banks lend to each other. And of course, if the cost of money to banks is a little higher, then they're going to pass that on to consumers. So the reason, of course, Tim, is inflation. Bank of Canada likes to keep the inflation rate around 2% because that means a good, healthy economy, not too overheated, but heated enough. But however, inflation right now is running about 6%, so 3 times where the government and the Bank of Canada like to see it. So one of the best tools in their toolbox to control inflation is interest rates, because as they put interest rates up, people borrow a little less, companies borrow a little less, and that helps. So how can people cope? Well, don't borrow unless you absolutely have to. Follow a budget, and it may be a good time as rates are going up to look at a fixed rate in terms of your borrowing rather than a variable rate.
So how much would an average mortgage go up with these interest rates going up?
Well, if you borrowed, let's say, $450,000 today on a mortgage as opposed to 3 months ago before rates started moving, your payment would be about $100 more per month. So it might not seem like a ton, but if you add that to the increased cost of groceries and gas and everything else, then it's starting to pinch people a little bit. So be careful in how much you're borrowing, obviously.
Well, here, because I don't know, some people got stretched pretty thin trying to get into the market. Like, is Bank of Canada worried that they stretched themselves too thin? Well,
you know what? The mortgage stress test put into effect a few years ago by the government. A lot of people complained about it. Mortgage brokers sometimes complained about it because people couldn't borrow as much. But what that stress test meant is you have to qualify for your payment if the rates went up 2% higher than you're actually getting. And now, lo and behold, the Bank of Canada is showing that that was a good test. Because now rates are probably going to be up 2% more than when you borrowed, if you borrowed a couple of years ago. So people should be able to afford it as long as they qualified in that stress test.
Okay, last one here. Investors, get in, get out now, stay in. What's the advice?
Well, if you look at the stock market, people say buy low and sell high, and that's easy to say. But when markets start going down, of course, people start getting nervous, and then their emotions, rather than their mind, to make their decisions for them. So there's no loss in the stock market. The stock market is going to be very volatile due to the war in Ukraine, inflation. All of these things mean the stock market is going to be volatile. Some days it's going to be up, some days it's going to be down. But again, the best strategy is to stay in there, because unless you sell, you haven't lost anything. And over time, and we've got 100 years of history in the stock market, it's always going to go up over time. So wait it out, and you will be rewarded for that.
Always great advice. Dave Skirman from First Ontario. We found that picture. Look at you on the end. We got Director Tansy, we got Gabe, we got Carly, we got Annette and Matt, along with Aaron. So thanks for having us. What do you got tonight? Bulldogs taking it tonight, pal?
Yeah, Bulldogs going to take it tonight, Tim.
Got good stuff. And we look forward to seeing you in 2 weeks' time in studio. Send in your questions. Win a gift card. Finance Friday at firstontario.com. You can go the Twitter route too, at finance_Friday. Have a good weekend, Dave.